Are you thinking of investing in UK property, but you're unsure on the best structure to have? For most people, a limited company is the best way to invest. In this video, we're going to touch on all the reasons why, how to set up your limited company, how to reinvest profits tax efficiently, and also how to get money out when you need it. Stick around to the end to make sure you don't miss anything. For those that don't know me, my name is Joshua Tharby. I'm a chartered tax advisor, and over the past decade or so, it absolutely pains me to say that I've worked with thousands of entrepreneurs to legally pay less tax. So why should you be looking at investing in UK property using a limited company? Oh, this is the first thing to cover because a limited company isn't suitable for absolutely everybody, but to be honest, the vast majority of people, it is. And the reason for this, in case you're a new property investor, you don't know about Section 24 and how property investment used to be in the good old days where you could have a portfolio of properties in your own name and not worry too much about the tax consequences. Unfortunately, that changed in 2016. And from 2018, 2019 onwards, basically it's usually been very tax inefficient. You end up paying more tax than you ought to by owning properties in your own name. The main reason for this is the Section 24 finance costs restriction. Broadly, what this means is where you own property in your own name, you will pay tax on your rental profits. You don't get any tax relief. Effectively, you don't get a tax deduction when it comes to calculating your profits for your rental income. So essentially, whatever your rental income is, no tax deduction for your mortgage interest or the expenses that you paid there. They will calculate your tax bill, ignoring that. You will then pay tax on that at 20, 40, 45%, potentially 60% if you go into that personal allowance taper threshold. And then you will simply just get a tax credit at 20% for the amount of mortgage interest that you've paid. So for anybody that's near the high income child benefit threshold, that's earning 40%, that's paying 40% taxes, 45% near the personal allowance threshold. Basically, having this property income in your own name is an absolute tax no-no. If you've just got modest other income and you are a basic rate taxpayer, it's not too bad from an income tax perspective owning that property in your own name because, yeah, you're going to be paying tax at 20%, but you do get that 20% basic rate tax credit, so it usually equals out. So if you do only want a couple of properties and you do only earn, £20,000, £30,000 a year, then in that case, a limited company might not be the best option for you. But if everybody that wants to grow a large property portfolio that's already a high earner, the chances are a limited company is the best way of doing this. We mentioned there about Section 24 and how, as an income taxpayer, if you've got property in your own name, you'll be paying tax at 40, 45, maybe even upwards of 60% effective tax rates on that income. Whereas when you invest in a limited company, the tax rates are substantially lower. So if this is your only limited company, essentially, you've got up to £50,000 of profits that your limited company can make, and you'll pay just 19% corporation tax on those. And it's worth mentioning that, of course, those finance costs that aren't tax deductible when you own property in your own name are fully tax deductible within a limited company. So it literally is whatever your net cash profit is for most landlords. After you've deducted absolutely everything, what's left, that's what you'll pay corporation tax on at much lower rates than you would if you own the properties in your own name. And this is powerful for landlords because it allows them to continuously reinvest and actually build the property empire. The best strategy that we see a lot of clients do is where they actually don't take money out of their limited company. They just pay the lowest amount of tax possible, so they've got as much left to then snowball into their next deal. They'll do a BRR, they'll do a development, pay the lowest amount of tax, so they've got more to play with, and let that compound over time until it does become a large property business. And then they start to look at how can they take money out of it. But for the first couple of years at least, it's all about reinvesting and paying the least amount of tax whilst they reinvest. And then, of course, with a limited company, you've got other benefits as well, such as the limited liability. So actually, if something goes wrong in your business, you're usually not personally liable, although most mortgage lenders will actually make you personally guarantee the mortgage debt. So there's no benefit just when it comes to the mortgage, but actually the wider commercial business, if something happens in one of your businesses, you get sued, you enter into legal difficulties, but actually you can rest assured that you've got limited liability protection. Whereas if you own those properties in your own name, that wouldn't be the case, which means your personal assets would be up for grabs, so to speak. And the last point, with a limited company, you've got a wider range of estate planning opportunities. You can bring your children into the company, you can pay them salaries from the company. You could check out the other videos about family investment companies and how to make a limited company very tax efficient when it comes to actually building that wealth, passing it on in the most tax efficient way. So for these reasons I mentioned, a lot of people invest in limited companies because it absolutely makes tax sense to do so. So your limited company, how should you set this up? And we're going to run through a couple of different cases that ultimately vary depending on your personal circumstances. So we've got here a simple limited company. Now, this is what a lot of property investors set up. And unfortunately here is, for a lot of investors, actually a simple limited company isn't the best way to go. The only time a simple limited company is the best option is if you're single, you're not married, you've not got children, and you're literally just looking to start building wealth now. And to be honest, you don't even plan on having any children anytime soon. You don't plan on getting married anytime soon, because with a simple limited company, you just set up one ordinary class of shares, you own the company outright, that's it. There's no flexibility around that. If you want to take dividends, you just take dividends according to your share class, pay income tax on that. You own the company 100%. You own all the capital rights, the voting rights, and ultimately the full value of that company is in your estate for inheritance tax purposes. But that makes sense. You've not got anyone to pass it to. You're not passing it to your wife. You're not passing it to your children. So actually, in this case, this is the best thing you can do because that's not on the horizon. So you just want a quick, simple, cheap, easy way to start investing in property, and a simple limited company is the best way of doing that. And then off the back of that, we've got freezer shares. This is where we take a simple limited company and modify it to basically create some more tax advantages to make it more favorable to your circumstances. So one of the clear-cut cases, best use cases of freezer shares when setting up a limited company is for a married couple. Say, for instance, you've got one high earner in the family, one who maybe looks after the kids or has low other income. Well, actually, if you just set up a simple limited company and either you owned it entirely or you were both on it, effectively, when it comes to taking money out of that company, there's tax issues to consider. Dividends legally have to be taken in accordance with the shareholding. So if you've got a normal class of shares owned 50-50, then effectively both of those shareholders have to pay income tax on those dividends. But with a alphabet company, you can actually have different classes of dividends, which allows for different levels of dividends. So you might have the higher earner who has the A shares, the lower earner having the B shares. And then what you would do is you'd put more dividends to that B shareholder, providing there's sufficient reserves. You've got to make sure that you do structure this correctly. But broadly, what that allows you to do is move money from the higher earner to the lower earner, potentially wiping out a massive tax bill, or at least saving tax at upwards of 25% when it comes to the income tax side of things. And then we go one step further in creating what is known as a family investment company. And this is the gold standard of company setup, so to speak. And you can also involve a trust here as well for further asset protection. And this is suitable for high net worth families because to get this structure set up, it does cost minimum £10,000 typically, maybe more with a trust as well. So you do need a large amount of capital to put in to obviously get that tax advantage and recoup those costs. But this is suitable for high net worth families where you are concerned about inheritance tax planning. You're married, you've probably got young children or adult children already, and you want a structure that's going to allow you to invest in property tax efficiently, but also pass that property on, pass the whole portfolio on without having significant inheritance tax exposure later on down the line. And this is where, when we set the company up, we have different classes of shares. Again, this is what it all comes down to with the limited company tax planning, is making sure that the classes of shares, the shareholders, the debt structure, it works for you and is the most tax efficient available. But with a family investment company, especially if you're setting it up on inception, usually you'll probably say, well, actually, I don't need any capital appreciation from this company. So we'll set the company up and say that all future capital growth goes to a completely separate class of shares, which can be directly given to the children, can be put into a trust, and then the children could benefit so that if they get married later on and they get divorced, well, actually, it's not their asset. It doesn't form part of the divorce proceeds, so it can really be protected and stay in the bloodline. And then you might just say, you know what, we want to control the company still. We want those voting rights because we don't want to pass them on to the children or have the trustees manage that, because we do actually want to control the company. And then depending on how much money you put in as a director's loan, you might want dividend rights, you might not. Quite often where we do this type of planning for high net worth clients, they've got a substantial amount that they'll put in, usually as a director's loan. It might be $1 million or $2 million seed capital. And quite often that's enough for them to put in and just draw down. They don't need any dividends from the company, but you can still have that attached to those share classes just in case you want to. And then other dividend rights to different share classes so that children can take money out tax efficiently, can pay for their school fees potentially, especially at university, depending on the end structure and depending on the exact structure of people going into the company, if it's grandparents, you, children as well, you can get very flexible in creating a structure that actually allows you to tax efficiently build wealth and, more importantly, tax efficiently pass it on. When it comes to setting up your limited company, if you are just looking to set up a simple limited company, to be honest, it's pretty straightforward to do this yourself on Companies House. It costs about £50. My advice, keep the share capital as low as possible and use a registered office address. If you are looking at setting up a company with freezer shares or a family investment company, you can't do this yourself. So you need to book a consultation and we can run through how we can do this for you. When you're setting your company up, just use the SIC code 68209. That works with pretty much all lenders and keeps you tax efficient. So now you've got your company set up in the best possible way. How do you actually run the company? What needs to happen? And whether you set up a simple limited company, alphabet, family investment company, the tax reporting obligations remain the same. So you've now got a limited company set up. That needs to file annual accounts to Companies House, needs to file a confirmation statement, basically confirming who the shareholders are, and also corporation tax returns. And all of this, usually you have an accountant do for you. With all of those deadlines, they're usually 9 months after the end of the company's year end. The only exception for this is actually the corporation tax return, but most accountants will have everything in hand 9 months from your company's year end. And that's typically 12 months from when you set the company up to the end of the month. That's your year end, so 9 months following that. So make sure that you do understand when your deadlines are, you don't forget about them, because quite often we see that people confuse their personal tax year with their company tax year. Well, actually, it's completely different, and it's all dependent on when you set your company up. But if you do want to keep things simple, you can change your company year end. Quite often, the 31st of December or the 31st of March are popular choices. Once you've got your company set up, what expenses can you claim for it? Well, the good news here is you can pretty much claim everything. So we mentioned mortgage interest, staff costs, office expenses, salaries, travel costs. You've even got your kind of trivial benefits exemption. As soon as you've got your limited company set up, you can start to use limited company tax planning opportunities. So a lot of people actually ask, Josh, can I get a company car through my property investment company? And absolutely you can. It's still tax efficient to get electrics and hybrids. So you can get a new Tesla through your property investment limited company, bring down the profits, and that's a great way of getting some tax efficient wealth out of the company. If in doubt, just ask your accountant if you can claim it. Realistically, most expenses are claimable. The only time we see it where HMRC flat disallow something is business entertaining. If you're taking landlords or estate agents out for lunch, their lunch isn't a tax deductible expense, but yours is. So the business is doing well. You've got properties, you've got cash flow, and now you're thinking, well, how do I get money out of the limited company? So there are a couple of different ways. I know we just briefly touched on company cars there, but these are the main ways to get cash out of your business. We'll work in order of tax efficiency. So a salary. If you've got no other income, no other personal income, a salary is an absolute must to take from your limited company. The reason for this is your personal allowance. £12,570. You've got it, your wife's got it, everybody's got this, even your children. So if anybody's doing any work in your property investment company, you should look to be paying them a salary to utilize their personal allowance. This is fully tax deductible, saving corporation tax up to 26.5%, goes in their personal allowance completely tax free. And then to add to that as well, even if you do have other income, but you're a basic rate taxpayer, it's still usually pretty tax efficient to take a salary out up to that 12,570 before you start becoming liable for personal national insurance. And then assuming that you've maximized your salary that you're taking out, what's best? Usually dividends. So after the company's made its profit and paid its corporation tax, whatever's left, you can take out as a dividend. We've got a paltry £500 a year dividend allowance, which doesn't do too much, but anything over this, you could take as a dividend. Where it's in your basic rate band, that's just 8.75%. And when you go over and above this, it does jump up to 33.75%. And for this reason, a lot of people like to plan their taxes around the basic rate band before taxes jump up 25%. So look at yourself, your spouse, even your adult children. Can they all be taken up to that basic rate band to maximize the wealth as a family, and more importantly, minimize the amount of tax being paid as a family unit? This is how the wealthy do it. They start to look at family units rather than just isolated tax returns, spread the wealth and make it tax efficient. And then once you've maximized what's tax efficient to take out as dividends, it's worth looking at your director's loan account. We touched here on clients that actually put a massive amount in. All of that seed capital that you loan to your limited company, you can, for one, charge interest on that. That again is very tax efficient. And then secondly, you can actually take that money out completely tax free. That's a loan that you put into your limited company, and that company, as soon as it's got profits available, that can just repay you. So if you put £1 million in, you could easily take £50,000 a year out of the profits of the limited company to you completely tax free. That's typically how we see the family investment company structures work. You might charge a small interest rate on there as well, use up the personal savings and the savings nil rate band, probably bring you up to £50,000 worth of interest income from that limited company. But then if you need six figures, you want 100, 150, pull the extra out from that director's loan account completely tax free. And those are the main ways of taking money out of your limited company. Of course, do check the specifics with your accountant before jumping into any sort of taking high salaries or high dividends or repaying director's loans, especially charging interest, because there's a little bit of compliance works that needs to be done when you actually charge interest from your limited company to you personally. So, is a limited company right for you? If you want tax efficient interest relief, if you want lower tax on retained earnings, if you want flexible growth and exit planning, and if you also want a structure that's great for building wealth, then that's absolutely the pros of a limited company. However, the cons, more admin and setup costs, you lose your CGT annual exemption, and the mortgages are still slightly more expensive than they are in your own names. But if you're planning to build a serious property portfolio and you want expert tax advice on the right structure, feel free to click that link below and book in a consultation with me where I'll review your personal circumstances and advise on the most appropriate structure and help you execute it. That's all for today, guys. Hope you find this video useful. Please do give it a thumbs up and smash that subscribe button. Bye for now.